Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Tuesday, the 8th of October. It is 1 o'clock on the East Coast. Swizzle here. That, of course, the great Carter Worth. Dan Nathan is in Texas. I don't know if I'm doxing him or I don't even know what it means, but he's at some hitter conference that he loves to attend. But we will make things right for you people. How are you, Carter?
I'm good. Which parts of Texas? Houston, Dallas, Austin, San Antonio?
It's where he was married, so I think that's in the Dallas area or something. But what do I know? But listen, it's great to have Carter here. There is a lot going on. We will effort a lot of different things. Let's look at the rundown quickly, if we may. Amanda and Timmy did a great job. NVIDIA drives tech higher. By the way, Carter had been pointing out that pennant formation that NVIDIA has been in. It appears as though we've pierced it to the upside. We will look. S&P sector check. Why not as we head into earnings? How high will yields go? We'll have that conversation. And if we have some time, we'll do a little audience Q&A. But before we get started, Carter Worth, we are at a critical junction here at Risk Reversal Media. We are north of 92,000, I believe, YouTube subscribers. We're trying to get to 100,000 before the end of the year, which will be here before you know it. That was a great snap, by the way. So if you watch and are not subscribed, please subscribe to our YouTube channel. Apparently, half the viewers are not subscribers. It's easy to do. Just go to the Risk Reversal media page on YouTube and hit subscribe, smash the shit out of different things, and there we go. So how's that, Carter Worth?
That works. Just hit that button. Isn't that
just
how
hit,
it works?
Just hit
so
that
much
button.
Of life. You just
so let's
push the button.
Let's take a look, because it's a CME day. Let's look at the E-minute futures in terms of the S&P. I don't know if there's a lot to sort of tell here. We've been sort of moving sideways for quite a bit of time here, seemingly since that, I don't want to say that early September sell-off. And here we are. It doesn't say a lot to me. I mean, the trend line is, in fact, the 150-day moving average. It would make sense at some point, I guess, to give another test of it. But right now, it shows no signs of doing so.
Yeah, we're just back to the July 16 high. So if you take that as the reference point, the market sells off 9.7%, recovers and makes a slight new high, and is basically sitting at that level. Now that's, of course, the S&P. The Russell 2000 also has a July peak, and it's not above it. And the Qs has a July 10th peak and is not above it. So the market itself sort of sitting here, and is so often the case, you get set up in a position that clearly reflects a standoff before news comes along to resolve the pattern. And we know what that is. Earnings start in earnest this week and next, and then it really kicks in. And it sounds obtuse, elemental, but good results will likely resolve the standoff up. Less good results resolve the standoff down. But it is a standoff. You can feel it. It's a case of equilibrium, and you make your bets. Or one says, I don't want to fool with this. This is more of a pair of twos. I want to try to pick individual stocks that are in better positions to either pay off as a short or pay off as a long.
Let's take a look at the NASDAQ, because it's going to be similar, although probably, if I had to guess, I think this chart looks a tad more vulnerable than the S&P chart. Thoughts on that real quick, Carter?
Right, so again, it has a July 10th high. It peaked slightly before the S&P on July 16th. They all have the same August plunge low, and they've all recovered in various forms and shapes since. But again, the July high in the NASDAQ still stands. The July high in the Russell 2000 still stands. It is the S&P, and only the S&P, that has been able to exceed its July high, albeit barely.
Yeah, it's, we're right there. And, we teased at the beginning in our little rundown that NVIDIA seems to have gone through that pennant formation. This is the one that we've drawn. I'm not suggesting it's right, but I think it's very similar to what you have drawn as well. Citi's saying it's remained stuck for the rest of the year. We'll see. I think what today at least means to me, Carter, is, that June 20th engulfing pattern that we've talked about a number of times. It looked very similar to what we saw back in March. That March engulfing pattern held up. We had a pretty significant sell-off. And then over the next couple of months, we sort of ground our way back. We had a conversation. You said that, okay, the work has been done. It was probably sort of setting up to go higher. And I think what we're seeing here is a bit of a replay. You know, that June 20th engulfing pattern, the stock obviously cascaded lower like everything did on August 5th, had the bounce, subsequent sell-off in September like everything did, have the bounce, independent. Now we've broken. So what I will say to you is now I think it's incumbent upon NVIDIA to sort of take out that June 20th high, I think of $140 and change. So thoughts on that?
Yeah, so the street has a collective price target of 147, 148, representing about 11% upside from here. We are moving to the upside out of the formation that's been in effect for basically 7-8 months. And so now the question is, does it or doesn't it make the new high? The poll that was conducted when we were sitting into the apex of the formation, 66% of respondents, this would be institutional clients, picked up and the difference down. So the bias was the upside. Indeed, that is how it's being resolved as of now. Remembering always that each individual, even if they're an institutional platform, has a bias, right? So if you're sitting there as the CIO of a major pension plan, you have a view versus the economist and a researcher in that same plan versus a family office, a hedge fund trader versus a hedge fund portfolio manager versus a long only, and it goes on and on. But collectively, again, 66% picked up, and as of now, that is the majority is right.
For now, and we'll see. But, you know, it's going to be interesting to see as we get into earnings. Obviously, I think some of this stuff with that super micro has helped NVIDIA, and we're starting to sort of have this levitation. You know, we'll see if this is sort of, you know, make this a little bit of a double top, or if we go blowing through the June. That's going to be the story. And obviously, as we get into earnings, everything, I think a lot of people are focused on that. Let's take a look at the sectors because, you know, you've broken down a lot of these things. This is changed today, obviously year to date. It comes as no surprise, I think, that technology is sort of back on its horse today, this sort of reacceleration higher. We just discussed it. Energy sort of on its rear end on the back of the China sell-off, I would imagine. And then everything sort of in between, materials sort of fit that bill as well. So there you can see today's activity, year to date, where we are. Now let's take a look at the work you've done because you've broken down these sectors really well for us. Take it away, Carter Worth.
Sure. So just the thought was to sort of look from a 30,000-foot view top down on the 11 sectors, and how they stand now is basically Q4 gets underway, and it's such a big next 35, 40 days. It's earnings, it's an election, it's presumptively a little bit more Fed or pausing, no Fed. But either way, the main thing here is it's in each instance, it's going to be a two-panel chart. The top panel is the sector in question. The bottom panel is relative performance to the market, in this case, the SPY. And so the first thing we know, of course, is how good tech has been, but also you see the weighting there. Remember it being at 32%. And really it's 50 because if you put things like Google back in it, right, and things that are in communications now, it still is basically half the market. But the curious thing is that we know we've recovered since the August 5th plunge low. You see the green arrow to the right, but the relative performance is stalling. In fact, the 150-day moving average is now downward sloping on the RSI line. My hunch is to be underweight. Let's look at the next biggest sector.
Well, let me just stop you there real quick. I'm sorry, because this, I think, the importance of this can't be underestimated. You know, 1/3 of the S&P is this sector. What you've just pointed out that although one would think it's doing well, when you look at its performance relative to the S&P, not so much. Now, I guess the next question, or at least my obvious question would be, is that sort of a harbinger of negative things potentially for the broader market if, in fact, 1/3 of this index, 1/3 of what the index is seemingly under pressure, or am I reading too much into it?
Well, there's a lot. So there are a couple of things. One thing about relative strength, there's something called autocorrelation, right? In the sense that the numerator and the denominator in this case is a big part of the denominator. So you, in a pure comparison, you would take tech as it relates to the market without tech in it. But the relative strength line as used by any software program that most everyone uses or charting package is as depicted here relative to the market. And so the question is, what does this imply? I think at a minimum, it implies, and this is the this is not the individual's burden or challenge or mandate, but the generalist has to play chess with the benchmark. Period. Hard stop. And most people who have retirement funds and in mutual funds are thing, those monies are being managed by a professional whose mandate largely is to come up with a result that's better than if you just passively put it into the market as represented by the SPY or the S&P. And so the real decision has to be made is this great area of the market that's been an outperformer, has delivered alpha, has represented an area to be overweight. Is it now time to not be overweight, equal weight, or even under? That would be my hunch, and the relative performance, that bottom panel, is a bit unhappy. I would say it has the characteristics of a bullish to bearish.
That's going to be interesting to see how that plays out, especially, again, as we get into earnings. So we will see. And again, yields, we're going to talk about, I think they may play a factor as well. Let's take a look at financials, 12.5% or so, almost 13%, excuse me, of the S&P. Similar story up top, different story down below. This seems to be sort of a textbook pair of twos to me, but I'll let you discuss.
Right, so it's an uptrend, and one could say, listen, I don't care about relative. That's not my thing. I have $1 million in the market or 100,000 in the market, and I want that to go up 10% to 1,100,000 or 110,000. But yes, while that's true, again, always remember or think of the backyard barbecue in 1999 in suburban America, where everyone's sitting around and John says how well he's doing. He's up 27%. And everyone looks at him like, dude, I'm up 40. I'm up 38. I'm up 58. You're up 27, meaning there's opportunity cost. And so what relative performance is all about, while not the mandate or the burden, again, the challenge of the individual investor, is what is so important in investing. And what we know is that the financials have been moving up and up and up, and they are not delivering any alpha. They are not delivering any outperformance. And remember, adjusted for beta, because there's more risk in financial in the general market, they are worse. The upper panel looks like it's an uptrend that's intact. The relative performance, just as of June, this is a 3-year chart, was making new 3-year relative lows to the S&P.
Which is, and I'll say this again, and I'll probably going to wind up saying this out of many of the 11 different sectors, but real quick, if you had asked me prior to seeing this, what I thought the bottom panel would look like, I would have said this probably looks like an outperformance, as I thought the technology would as well, relative to the S&P, and you're not seeing that at all. So sometimes it's one thing to talk about them. It's an entirely different thing to see it the way you bring it out. So please continue.
Yeah, and that's the hope of good visuals, right, to make it approachable. And all right, let's move on. So now the next sector, and you'll see here at 12%, so just slightly less. But remarkable, right, to think that this is Lilly, which has been a killer, right? And this has got device companies like ISRG, the people that Intuitive Surgical do the robots in the operating room versus the guy with the magnifying glass and the butter knife. Science is good. And no alpha, nothing. Straight down underperforming. And, what do you do? Now, one could say, yeah, but it's so extreme, it's going to turn eventually. I think that this is a contrarian play, and ultimately because healthcare offers offense and defense. And so in the event of general continued market appreciation, healthcare comes to life relative, and or in the event of general market malaise or weakness, that healthcare offers a defensive. But the relative strength, or RSI, is what it is. I mean, as of June, this area of the market was making new 3-year relative lows.
Yeah. And if we could put up real quick, I'm asking on the fly, Amanda, but if you could put up an Eli Lilly chart over that same period of time, I mean, it's probably makes a little bit of sense, because although Eli Lilly was a monster, it has seen a bit of a sell-off, and I think United Health is the second biggest weighting in that as well. So you look at Lilly here. I mean, you see those little move. I guess it doesn't even look that bad, quite frankly. I mean, I thought it was going to look a little bit worse, but we traded down the moving average and it bounced. So it is interesting, even with Lilly, sort of treading water here, how the underperformance of the sector. So again, it's all in the math, and the math doesn't lie. Let's take a look at, I think the next one is the XLY, the consumer discretionary.
Right. So this too, think about it, this is Home Depot, This is big names. It's only 10%, not only, but it is. It's less than 10% of the S&P. The one thing that's perhaps a bit encouraging, despite this unending relative underperformance, is that it's starting prospectively to turn, and that the relative performance has the elements of a bearish to bullish reversal. And so I would say if one has to go and think of it in terms of an institutional manager, overweight, underweight, or equal weight, a slight overweight makes sense here.
Communication services, 9% of the spider. This is, again, going to look great up top, sort of sideways to nowhere down below.
Yeah, I mean, it trends beautifully. Look at the upper panel. There are bull phases, there are bear phases. We're in a new bull phase. When the 150 moving average turns down in 2021, a bullish to bearish reversal. When it flattens and turns back up in 2022, a bearish to bullish reversal. Uptrend's intact, bounces off the moving average to the penny. And yet, one is just as well off in the SPY. No alpha.
This is the one, the industrials is the one that I think, I mean, they're all interesting. This is the one to me that maybe you get the most bang for your buck because, you know, as you can see, we had that pretty steep decline, but now it's seemingly back on its horse through the averages. Thoughts on the XLI, the industrials?
So again, it's shocking to think that you could look at that upper panel from the bear market low of 2022. And you didn't know what it was. And you said, wow, that's a beauty. That's up and to the right. And yet just as of June, it was making 3-year relative lows. Cost of capital, opportunity cost, an unhappy event. And yet, obviously, since the June sort of late June, July low, you've had an aggressive instance of relative performance. And so independent of what one's view is, think about what does this say about recession or no recession? What does it say about maybe China, even though that's brand new, that story? But for industrials to be acting so well relative to the market and also to be a decent and orderly uptrend in and of themselves on the absolute chart in the top panel, it does say prospectively that the notion of a recession or some sort of contraction on Main Street or is not likely.
This is a fascinating, this is the most interesting one to me. And obviously we can, maybe in the notes, we can put the names of the industrials. So let's go to these are the staples now, which is about 6% or so, I think, of the spider. Thoughts on this one, Carter?
Right, big names in here. There's Costco, there's Walmart, there's Procter & Gamble, Schmucker's Jelly, Campbell's Soup, General Mills, Mondelez, it goes on and on, Coke and Pepsi. And now, over time, these kind of assets underperform. They're no growth. They're higher dividend paying. They're safety names. And you can see, of course, what did they do in the 2022 period? The S&P dropped 27% to its October low, a bear market in 2022. The NASDAQ 100 dropped 37. And what did the bottom panel do? Straight up, right? They do well in periods of stress by virtue of their defensive characteristics. But the real issue here is, even as a move like that, over the past 12 months, to be up, what is that, 65 to 85? I mean, that's incredible percent and no alpha whatsoever. I don't like it.
Now, pictures, again, I'll say it again. You know, you think one thing, you see it visually, it tells you an entirely different story. Now, the next one I think is fascinating to me as well. It comes in the form of the XLE, energy, 3.5% of the SPY. And this is one, to be honest with you, I thought would actually look a little bit better. It doesn't.
Right. So talk about a standoff. We know that energy coming off the COVID low was one of the best performers, hard stop, if not the best. And then only because of how poor the performance was because of COVID. No planes flying, no cars driving, everyone saying. And so energy was the worst performer on the way down and the best performer on the way back up. And now it's been this 2 to 3 year standoff. If you go sideways, top panel, while the market's going up, your bottom panel goes down. Simple as that. And so the question is what to do. We have this as an overweight. We think that ultimately this standoff, the sideways actions get resolved up. But as of now, here's another instance of an area of the market that is not rewarded the individual who has made a general bet on the area of the market relative to the other choice, just betting on the market.
With all the talk about utilities, one would have thought this next slide would look a lot better than it does. Now, I will tell you, it's seemingly starting to turn in your favor, but I thought this turn would have happened a lot earlier, and I thought it would have been a lot more, I don't know, vicious to the upside. Now, maybe it's the start of something. I think the arrows suggest you think that, but talk about the utilities real quick.
So in and of themselves, they're steep, uncorrected, and if one has gains in this, I would harvest. The relative issue is what's nascent, interesting, and prospectively the beginning of something more enduring, right? So you have a bearish to bullish reversal buy as it relates to the bottom panel. If that were a stock or currency or commodity or any ETF, it's making the turn. The question is, right, how steep and uncorrected XLU is. And that's the issue. If I were long XLU here, I would be selling calls against my long position.
Real estate small. We'll take a quick look. It's going to look like a pair of twos. That comes in the form of XLRE. But materials is really where I want to go, because obviously we're going to talk about China in a second. Given what's happening there, last night notwithstanding, I mean, they seemingly are throwing a lot of money at the markets, and I think one of the big gainers, or one of the big sectors that's going to be rewarded, Carter, is going to be materials. And I think your arrows suggest you agree with me.
So the in and of itself, obviously a very small area of the market. Now, these are prominent names like International Paper, U.S. Steel, and Dow Chemical, and DuPont, and so forth. But to think that one apple is 6% and the whole sector is 2%. Either way, the question is, in and of itself, is the upper panel a decent chart? It is. The issue with the improving relative performance in the bottom panel is that it's returned to the penny, to the declining 150-day moving average, an inherently difficult level. My hunch is to sort of be equal weight this area.
Mm-hmm. All right. Now, everything, as always, is seemingly, well, I shouldn't say that. Yields has been such a big story. You've correctly pointed out that, maybe yields are not as big a story as people like me think. Now, let's take a look at your charts in terms of the 10-year, because it appears as though with this bounce, we've gotten right to a level of seemingly resistance in the form of, this downtrend we've been in since the spring. So let's walk through some yield charts.
Yeah, I mean, a big move, to be clear, and we all see it here day to day and know it. And gold, for instance, and silver having a bit of a hit today, finally responding, having not responded on Thursday and Monday to the move up. But we are what I would characterize as a rally to a difficult level, or in the case of bonds have sold off aggressively to the point where you do have some rebound potential in bonds and some backing away in yields. So here we are at the 4% level. And this is then, which brings up the longer term charts. And so we have the COVID low here. Basically, the cost of money dropped to almost nothing, 30 basis points. And then we have this great period of movement. Now, what's important to state is never once did yields close higher than 5%. Never even got there. So the whole higher for longer thing is preposterous. It was never higher for longer. Consensus at one point was 6.5%, 7%. That's just extrapolators. The extrapolators come in at 5, they extrapolate to 6.5. And then just 3 weeks ago, they were going to cut and cut and cut and cut. Now they're not going to cut. Anyway, another way to draw the lines, we can just toggle, is the next. So these two, whether one considers it's what a pair of twos is, it's stuck. And so then the real question is, do rates matter? I think they're just basically, this is why the market maybe has been so resilient, that the market has figured out that rates never were going to do higher for longer nonsense, 6, 7, and nor is there a recession, that it's the Goldilocks, that the cost of capital for 10 years at 4% is something in any other generation you would seize on.
100%. You've been on it. You've been correct. Real quick, I'm going off script. Throw a TLT chart up, man, if you can, and go back to sort of this time last year. And, you'll see this level that we just traded up to. When we trade higher in TLT, I know people know this, but if anybody new, that's when yields are going lower. And as TLT goes lower, that's when yields are going higher. So I pointed this out on the show last night, and I'll point it out again. If you look at where we just topped out at, that's pretty much where we topped out at back in December. So when yields were at their lowest, that's when TLT was at its highest. So short-term bit of a double top here. But to your point, we're now at levels where seemingly we should stop and bounce from. So if we were to bounce from here in the TLT, it would mean yields are going to start heading lower again. So I just wanted to point that out real quick. We can throw up the CME Fed Watch tool. It's going to probably reinforce a lot of things people think. Basically, an 86% chance of a 25-point cut in November. We can look at the December meeting as well real quick, and you're going to see very similar. So the market is sort of on cruise control in what they think is going to happen. I mean, the real question is, and that's probably for a different show, does the Fed even matter at this point, or are there other forces at work? The one thing I did want to take a look at real quick, Carter, was gold. You mentioned it. It is selling off today. Probably makes sense given what's going on in China. I still think the move is intact. Maybe there's some short-term pain that we're going to have to endure. But in my opinion, nothing's really changed on the gold front.
Yeah, uptrend intact. The silver, we have that. Maybe is the one to pull up. It's taking a bigger hit today, and obviously that's again an issue of beta. Silver is the one that is really, you can see here, taking a disproportionate hit in relation to gold, but also in response to delayed the move in rates over the past 3-5 sessions.
Let's take a look. I think the big story of the day that we're just getting to now is what's going on with China stocks and the FXI specifically. And you brought a really interesting, this chart is fascinating to me. This speaks to probably overbought conditions. And when we get to certain levels, how we've seen sort of a sell-off on the back of these levels. I think there's some arrows that are going to depict exactly what I'm talking about. But walk us through this because, you know, I do think there was an anticipation that you'd sort of see a bit of a back and fill at some point here in these Chinese names.
Yeah, we sent this out to clients last night before Hong Kong opened. So with a little double lock and a little good timing, Hong Kong has crashed today. If you look at the top panel, simply this is FXI, and hold aside the oscillator on the bottom, we are now higher above, and that was the point of the blast to clients, at any time above the 150 move average of the past 20 years, period, hard stop. There is no, we did the math on it, that's it. Now, if you use an oscillator, which is what is depicted on the bottom, an RSI, and again, not RSI relative strength to something else, but RSI and oscillator, very different things. And the second chart is what we then set out two charts, and we just, we could flash those. The point is, there are no exceptions, none. That's it. It's hard stop, like you were setting in Western Union Wire in 1910. Hard stop. That's the end of the Western Union communication. There are no exceptions. It is sold off every single time whenever it was this extended above the 150-day, and the RSI oscillator was this overbought. And we're now, you know, it's crashed today. It's down 10%. Now, what to do from here, we'll see. But I think it's important to respect in any given moment when something really is overdone, whether it's to the downside or upside, and try to navigate sort of wisely in advance of what is inevitable, mean reversion.
FXI, if Amanda can throw up a chart longer term on one of our charts, and this is something we talked about February, March of this year. You know, I had pointed out, and Dan as well, I know you did, that where we traded down to in the FXI was basically the same low we saw in the fall. Need a little bit of a long, actually, that's good enough. So if you see where that's it. So you look at where we traded down to, you look at that previous low in the fall of 2023, and you'll see there was a really nice double bottom to trade against. Now, I will be honest with you. I thought we'd see a move, maybe not of this magnitude, but I thought we'd see a move higher a lot faster than we did. But here we are now. I think it's logical to think we see sort of a back and fill to the moving average. Maybe that comes in around 30 or so in the FXI. But that, I only point this out to show sort of the power of that double bottom. If you want to throw up a quick Alibaba chart, you know, 125 was sort of on my radar screen for a while. I think we got to 121 or so. That got us basically to a high that we saw back in January of 2023-ish. So it makes sense, I think, that we sort of stall here. But what I will say, I don't necessarily think this is over, but I think it's in for a bit of a respite, Carter.
Yeah, I mean, a lot of money pumped into a lot of individual stocks and to a lot of aggregates related to China. And now what? Profit taking can be quick and violent. Try to buy dips, but not day one. Day one of a setback that comes after a very steep 50% move is almost always more downside.
Ramesh's question sort of is what we just addressed, but pull it up real quick. Can you or Carter opine on the China stock market seemingly lost steam? That's what we just sort of talked about, but I wanted to bring it up because I know a lot of people had questions. Carter's, this is Albemarle. This is something you've brought up before. Scott A is asking about if you have any view on ALB. Now, this is something I haven't looked at. I think it's had a decent run as of late to the upside, unless I'm completely mistaken. Yeah, it's had a little bit of a bounce, I guess. But this is something that's sort of, been stuck in the mud now for quite some time.
Can we pull up the chart so that
ALB? Absolutely, yeah. So we're right up against the 150-day moving average. If you look at longer term, you'll see that this stock has been basically upper left, lower right for quite some time. I don't think that's been broken yet. I mean, maybe there's a chance of a bearish to bullish reversal, but I think it needs to do some more work before we see it entirely.
Yeah, I mean, the question is that and again, here's what's so incredible to think that, and this is not a small trifling company, what is something worth? How could it be worth $100 in 2021 January, then worth $350, and then worth $100? Valuation is one of the worst timing tools. What we want to try to do is respect things that are in uptrends and indeed respect things that are in downtrends and try to find changes in trend. The question is this a bearish to bullish reversal? It's nascent, it's young. I'd be long, small to start, and add on strength only.
Millennial market, Nike comeback question mark, Starbucks question mark as well. And obviously we just talked about gold. So if you look at Nike, what I think is happening here, we obviously had that huge downdraft back in June. The stock, I think, went from about 95. I think it sort of bottomed out around $70 or so. But you had a huge downdraft that took us right down to about 75. And then we sort of teetered lower. The move that we've just seen on the back of the news gets us right back to where we sort of cascaded lower from. So I'm of the belief that, maybe, and this is my opinion, Nike, maybe we've exhausted ourselves with this bounce. What are your thoughts on this?
Yeah, pair of twos for me, meaning when the prospective move, the potential based on the setup is large, we could really catch a breakout here. We could really you could really see a break to the downside. Then we want to bet. When it's maybe not, or hey, there is no less betting or no betting. Pair two, I'll just leave it alone.
I agree with that. Jody Edmondson's asking, and we addressed this, but if not the XLK, which sector has the best RSI compared to the S&P 500? We'll put all those charts in the show notes, I think, but we sort of addressed that. If off the top of my head, I think it was, I want to say the industrials. Maybe I'm wrong, Carter, but you probably know off the top of your head.
That's right. Over the past 3, 5, 7, 10, 12 weeks, it's industrials.
Let's see real quick. I'm just looking for an interesting question. Oh, this is from Matt Walter. How often do you consider seasonality when looking at charts? I think I know the answer to that, but please.
I don't.
Yep.
I mean, look, there's so much good work being done. A lot of people use oscillators. Some people MACD and Bollinger Band and RSI. Some people like DeMark. Some people don't believe in volume. They say volume is not important. I think it's the number one thing that you can look at.
I agree with the volume, by the way, for sure.
Each his own. But seasonality, again, there's a lot of work being done on that, and you can find it out there in the public domain.
L87P, thoughts on KWeb? We sort of addressed it in terms of Chinese stocks. What I'll tell you is KWeb sort of topped out around 32.5 or so back in May. Then it sort of continued its move lower. What I think is going to happen is, given this move up to, I think, 39 or so, you're going to see a sort of back and fill to that prior high of 32.5. You can sort of opine quickly, but that's, that's what my eye sees, Carter.
Yeah. So here too, it's just a big move, overdone. Now the profit takers are hitting it, and I would expect there's further dipping or pulling back in the days ahead.
You are the man. I want to emphasize once again, please subscribe to the Risk Reversal YouTube channel. According to Amanda, Timmy, Jacob, and even I want to say Mr. Bill Hockman, half of the people are not, half of our viewers have not subscribed. So we're trying to get to 100,000. Please check it out. Market Matrix now in our 7th year. I'm kidding, but it feels that way. But it's probably week 22 or 23 of Market Matrix. Check that out. Tomorrow I'm with EYT. And then Thursday, Dan will be doing Market Call with, I think, Carter Worth. Bit of an interesting week, but got a lot of moving parts. I want to thank Carter Worth. Obviously, thank you, audience. Please subscribe to the Risk Reversal YouTube page, and we'll see you tomorrow, folks.
Bye.